balance the possibility of losing money with the chance of earning profit. So let's start by understanding what this trade-off means. So the risk return trade-off means that to earn higher return, investor must be willing to take on more risk. So for example, ani is ang government bond which is ga acquire siya og low risk but give small return while ang stock are riskier pero mas higher profit ang iyahang ma-earn ana. This trade-off is usually shown using something called the risk return line. The next is the risk return line is simply mean it shows how much return investor expect for a given level of risk. If the line is step, so it means people really dislike risk, so they want high rewards before taking it. So if the line is flat, so pero if flat lang siya, then managers should aim to choose projects that lie above the risk return. These are the ones that add value to the company. Next. Next na, Jillian. So, investor behavior over time. Investor behavior doesn't stay the same. Before a financial crisis, many people are confident and take more risk to earn higher return. But after a crisis, investors became cautious. They moved their money into safer options like government bonds. Today, many investors try to balance risk and return by building diversified portfolios, combining both risky and safe investment. So this helps reduce losses while still in earning a good returns. Next.
Okay, so let's move on to the standalone risk. For the standalone risk, it is when a risk of an individual asset or project without regard to any other assets in a portfolio. So for a standalone risk, it measures how risky a single investment is on its own. So you have to assume na more na dito tayo magigunitan na asset. So if you are evaluating whether to invest in one project, standalone risk looks at how much the project returns could vary. So this will be determined by different statistical measures for the standalone risk. First one is we have the probability distribution. For probability distribution, it lists all possible outcomes with proper probabilities. The possible outcomes are your returns and their probabilities or the likelihood of your returns sa katong mga outcomes. It shows the range and likelihood of your returns, and also it helps us to visualize how uncertain or spread out the possible returns are. Next is we have the expected return. This is the average return an investor expects from the asset. So this always based ni siya sa ato ang possible outcomes. Therefore, it represents the most likely na return nga imong madawat. Most likely return. Next is the standard deviation. In statistics, the standard deviation measures how varied your data is from the mean. So, in terms of investments, it measures how much actual returns vary from the expected. So, the larger your standard deviation equals the greater your volatility, and equals higher, so higher jud imong risk if larger imong standard deviation. For the coefficient of variation, let's go back to the variance. The variance is simply the square of your standard deviation, and it shows the total variability. So the standard, so but dili siya parang preferred for interpretation since the standard deviation is more preferred. And then for the coefficient of variation, it is used to compare risk relative to return. So and especially when you're comparing two assets with different expected returns, and it shows how much risk you're taking per unit of return. So the lower your CV or the coefficient of variation equals the better risk return trade off. Lastly, we have the Sharpe ratio. This ratio measures how much excess return per unit of risk. So for this one, an investment provides each unit of risk, and it answers the question: how am I kanang properly rewarded for the amount of risk I'm taking. So ni compensate ba jud ang imuhang return sa risk imong gi-take. And so next slide. Mm. So for measuring standalone risk, we have the expected return, which is again the average returns, then standard deviation showing the spread, how spread your the shows the spread of possible returns, and its interpretation. Tight distribution equals low risk, wide distribution equals high risk. Again, if higher imong standard deviation, I like medyo like bubo na imong standard deviation, mas low imong risk. So kung mas dako jud imong standard deviation, higher imong risk. And its purpose is to measure how much actual returns differ from your average return.
So for the interpretation nga part guys no, sa standard deviation na ingon na ni Jasmine, the higher the standard deviation, the higher the risk. So pag-interpret dayon sa coefficient of variation, mo ni siya ang ga-measure risk variant of expected returns. So useful na ni siya pag compare sa different assets katong ang gingon nga dili ni siya good for interpretation. So move ta sa Sharpe ratio. Ang Sharpe ratio, a good Sharpe ratio is generally considered to be above 1.0. So kibale, mo na siya, if above siya 1.0, meaning the investment is generating strong risk-adjusted return. So sa example dari nga si Martin is equal to 0.1111 low efficiency. So kibali, ga-suggest na siya nga ang risk niya is too excessive for the return. Then ang kaniding TUS water equal nga ang uh, Sharpe ratio is 1.55 high iyang efficiency. So ga-indicate na siya better performance. Next slide please. So risk aversion and required return. Most investors are risk averse, meaning dili gid sila basta-basta mo jump in sa mga high risk bisan pag high return na siya nga mga investments. That's why they demand a high risk premium for higher risk. Ang pagkuha sa risk premium no is expected returns minus risk free rates. So kay gusto man sila nga taas ang ilahang premium mo nang ang prices nila is gina-adjust nila hantud sa ang ilang expected return is maka ano na sige, properly compensated for the risk. So ang key takeaways lang nato for this section is risk is measurable and comparable using the standard deviation, uh you call this coefficient of variation and Sharpe ratio. Then kato din yung mga mention lang ganiha nga higher risk meaning high reward return or risk premium. Then kaning diversification reduces company specific risk. Kuan ni siya kanang this means that sa diversification mapaubos ang risk sa diversification because diversification is a risk management strategy that involves spreading investments across different types of assets. Una siya. And then last, the focus on adjusted performance, not just raw returns because ang adjusted performance mo good is gatan-aw na siya sa um do you call this sa na-adjust na nga ratio dili lang sa raw nga mga return. Kibali with risk free rate na siya. So thank you, that's all. I'll turn you over to the next reporter.
So moving forward, risk in a portfolio context, the capital asset pricing model. So a capital asset pricing model is a model based on the proposition that any stock's required rate of return is equal to the risk-free rate of return plus a risk premium that reflects only the risk remaining after diversification. In layman's term, the capital asset pricing model is essentially a formula that tells an investor what return they should expect to earn or the required rate of return for taking on a certain level of investment risk. As shown in the slide is the formula. This formula tells you the expected return on your portfolio or the return you anticipate earning from your entire collection of investments. In short, your portfolio's expected return is simply a weighted average of the expected returns of all the individual stocks you own. So, combining assets can reduce total risk. The big idea behind this is don't put all your eggs in one basket. This simply means you should not concentrate or put all of your efforts, resources, investments, or assets in one area because if that one thing fails, you risk losing everything. So when you create a portfolio or a collection of different assets like stocks, you can actually reduce the overall risk compared to holding just one stock. This is the concept of diversification. So the total risk is computed by adding diversifiable and market risk. Diversifiable risk is the risk specific to one single company. It's caused by internal problems like a bad CEO decisions, a factory fire, or a product failure, while market risks are unavoidable risks. This risk affects all companies and investment at the same time. It's caused by major external events like a recession, a sudden surge in inflation, or a war. The two types of there are two types of risk: what you can fix and what you can't. So the total risk of any investment can be broken down into two components. First is the diversifiable risk, also called as the unsystematic or company specific risk. This risk is a unique to a specific company or industry. So think of a sudden labor strike at one firm, a specific product recall, or a key executive resigning. There is a good news in this diversifiable risk. These events are random and specific, so you can eliminate this type of risk by simply owning a variety of stocks across different industries. So when one stock goes down due to a company specific event, the others are unaffected or may even go up, balancing out the loss. Next is the market risk, also called as the systematic risk. This risk is driven by economy wide factors that affect all companies in the market. So think of things like a recession, a sharp increase in the interest rates, or a major geopolitical event. But there is a downside in market risk. The risk cannot be eliminated through diversification um, because it impacts every investment. So it's the risk you have to live with when participating in the market. So there is a limitation of the diversification. So while diversification is powerful, it has its limits. Once your portfolio holds around 40 to 50 different stocks, you have likely eliminated almost all of the diversifiable risk. So adding more stocks beyond this point provides little to no extra benefit because the only risk remaining is the inescapable market risk. So you are left only with a risk inherent to the overall company. Next is the portfolio beta. The concept presented is the portfolio beta, a crucial measure for understanding a portfolio's systematic risk. The portfolio beta is calculated as the weighted average of the individual betas of the assets within the portfolio. Portfolio beta shows the portfolio's sensitivity to market changes, its exposure to non-diversifiable or systematic risk. The market itself is defined as having a beta of 1. So, when beta is greater than 1, uh, the portfolio is more volatile than the overall market. When the market goes up or down by 1%, this portfolio tends to move by more than 1%. When 1 is greater than beta, the portfolio is less than volatile than the overall market. When the market goes up or down by 1%, this portfolio tends to move by less than 1%. But when beta um, equals to 1, the portfolio has the same volatility as the overall market, for the weighted average of the individual betas. So the interpretation regarding risk and return is uh, the higher beta to higher expected return. Investors require a higher expected return on portfolios with a higher beta to compensate for the greater market risk or volatility they are taking on. So higher beta, higher expected return to compensate for their risk. That's all. Thank you.
Hello, hello. Good evening, everyone. So to continue the talk about CAPM, let us move on to the relationship between risk and rates of return. So the key question that we would answer here is what return is required to compensate the investors. So we pivot our discussion on the main equation, which is the required return on stock L, which is the risk-free return plus the market risk premium and stock L's beta. So risk-free premium is the risk, the rate of risk that does not involve any inflation. It simply is the risk that you get from investing a single stock. To add this to the market risk premium is what the risk, the associated risk that the investor benefits. And then the stock else beta is the beta coefficient which was explained by Ate Jace earlier, which is when the beta coefficient is equal to one, it moves with the same as the market. When the beta coefficient is greater than 1, it means that it is more volatile or it swings frequently. And then if the beta coefficient is less than 1, it means that it is calmer or there is smaller amounts of swings. So next. Security market line is the equation that shows the relationship between risk as measured by beta and the required rates of return as individual securities. So if we imagine a graph here, the beta coefficient is the x-axis and then the y-axis is about the risk or the rates of return. So the slope is the RRF or the market market risk premium, in which these are the points in the points in the graph, the intercept, the risk free rate in which where the direction of the graph is and dictates if the graph would be steeper or not. So higher slope meaning that it has a higher risk of inversion. And then point above SML means that it has a positive alpha, which also means that it is an undervalued security that is generating a higher expected return that it should, given its level of systematic risk or event. Investors perceive this as an opportunity because they can get better return for the amount of the market risk that they are taking on. So next is the impact of expected inflation. This is where we're talking or considering about the real risk-free rate and the inflation premium. So as we can see in the graph, right, the x-axis is the beta coefficient and the y-axis is the required rates of return. So the greater the beta coefficient and the greater the required risk of return, greater the risk. Okay, next. The next graph is all about risk aversion. So, risk aversion, the graph is talks about how the investors become more risk averse. So risk averse, when the investor becomes more risk averse, the market risk premium rises, or the market risk premium. Yes, and then the SML becomes steeper. As we can see in the graph, the second SML is much steeper, meaning the points in the graph from the previous SML is higher than the other points, and then higher changes in the risk aversion and aversion causes higher required returns for risky stock. Okay, so that would be all for me. Thank you.
Next slide, please. So, we all know that the beta is the measure of the stock market risk or how much it moves compared to the overall market. And then the market average of beta is 1, means that beta of 1. And and above 1 it means it's more risky and below 1 is more stable. So a company's beta can change over time due to internal and external factors. It might increase if the companies take on riskier projects or add more debts or with external factors such as more competition or loss of patents or due to inflation rate. And a decrease if the company becomes more stable, pays off debts, or focuses on steady operations. When beta goes up, investors see more risk, so they demand a higher return rate before buying the stock. So for example, using the capital asset pricing model, which na-discuss na ni Mark kanina adiri sa kilid. For example, if a company beta rises 1.48 to 2.0, its required return might go from 13.4% to 16%. But because investors now want a higher return rate, the stock price usually falls. It becomes less attractive. When beta lowers, it's the opposite. The stock becomes less risky, investors require a lower return, and the stock price tends to rise since it's seen as safer. To sum up, beta shows how much a stock moves compared to the market. A higher beta means higher risk and higher return, where a lower beta means more stability. When beta rises, investors demand higher return, which can lower the stock's price. When it falls, the stocks become safer and more attractive. Next slide, please. So this concept is central to the capital asset pricing model, which is used to determine the return of rate using the beta. So it is popular and simple way to estimate a stock required return. Pero however, studies showed by Eugene Fama and Kenneth French found that real stock returns don't always match the CAPM's prediction based only on beta. Because of that, newer multi-factors were developed to include other risks like company size and value. Still, despite its limit, CAPM remains the most widely used tool for estimating expected returns.
Next, please. So, why is it important to know the risk and rate of return? So, first is risk return trade off. So, as we all know, higher risk mean higher expected return. So, it is important to let the investor know about it. Uh, Second is diversification, which is discussed earlier. So, diversification means that an investor should know that the investor should be not eligible enough to invest their money bitaw uh, sa lahi-lahi nga company, sa lahi-lahi nga stock to to lower down the risk of some stocks kay naa man gyud uban nga galow tapos if ever man na daghan kag stock nga na-invest napod kay makuan bitaw mabawi ra bitaw siya dito sa kanang mas taas og returns nga imong gi-invest. So that's why mas mubaba ang iyahang risk nga imong makuha. And then third is real returns matter. So investors should also know nga dili lang sila dapat
mag-asa bitaw ng mga ah, returns bitaw nga abi nimo for example nominal return dapat ato pong ang investor pod is consider pod nila ang ang real return which is for example kay sa inflation dapat mag kuan pod sila ila pong consider ang inflation adjusted returns bitaw nga mahitabo sa money kay para tagaan yun og value ang ilang gi-invest. Next is investment horizon. So, ang investment horizon which means that longer holding periods reduce risk. So, it means kanang ang imong gi-invest kay mas kuan siya mas dako siyang value if ever mas long term bitaw siya kay magod in short term mas dako ang risk tapos ang mas dako ang risk and then ang long term kanang murag makuha na bitaw siya reduce na bitaw ang risk kay mas less risky na magun ang return kay maka-recover na ka sa imong gi-invest and then kuan napoy nang napoy time na kanang ang kana imong gi-invest kay mas kuan na siya mas ano yun mas makabawi siya and then next is past is not the future. So, kung siya, historical returns don't guarantee future performance. So, as an investor, no, dili lang tan-awon nimo ang history sa kanang stocks nga imong gi-investan. Dapat kay ano pod kanang imong tan-awon ang current kay dili magyud nang ga-guarantee bitaw ang kanang past bitaw nga events kay kuan man uncertain magyud ang future. That's why kanang imong tan-awon ang current price sa usa ka stock which is kuan kining good pa ba siya nga investment today ang based on its current price and then imo pong as an investor pod kanang ang imo pong tan-awon ang performance of a company that current year or something. And then corporate future decision making. Assess how new projects affect firms' overall risk and stock beta. Managers aim to maximize stock price by managing risk effectively. So, ang siyempre, as a manager, no, kailangan pod nila mabalaan ang risk and rate returns kay ang common goal gyud sa usa ka company is mag-maximize sa ilahang wealth. And then there kuan dapat ang ilang risk nga ilang take bitaw kay maka-guarantee po siya high return pod. High risk means high return. So kuan gyapon ang mga managers is mura gyapon gahuna-huna ra gyapon na sila same as an investor gyapon kay kuan man kanang mura ra man gyapon sila invest tapos ginahuna-huna pud nila ang well-being pod sa usa ka company and then it's very crucial kay kuan man siya kanang kuan sa whole company man ang maapektuhan. That's all. Thank you.